6 o'clock. But before that, lenders are cutting mortgage interest rates, which is a positive sign in the mortgage market. And to discuss where we're going from here in 2024, I'm joined on the line by David Hall, who's the CEO of the Irish Mortgage Holders Association, and Margaret Barret is Managing Director of Mortgage Navigators. Good afternoon, both of you. Welcome to the programme. Margaret, let me start with you. And as we said, some lenders are cutting mortgage rates. There's a bit more competition in the marketplace, which is helpful.
Absolutely. And I suppose we're coming off the back of a number of rate hikes over the last possibly 2 years, and we saw the European Central Bank increase their ECB rates from 0% all the way up to 4.25%. But it's good to see, Adrian, that we're seeing a lot of the main Irish lenders having recently actually in fact reduced their interest rates from anywhere from 0.25% up to even 0.5%. So whilst we're not back in the days of the 1.9% fixed interest rates, we're certainly seeing interest rates at around 3.45%. So there's value to be had, I think, in the market at the moment. So
that pressure from increased competition is dampening rates a little bit in the market.
Yeah, so I suppose the reason we had rate hikes is that inflation in Europe was increasing in double digits. We're now seeing inflation in Europe at 2.4%. The goal is to get it to 2%. So the European Central Bank are meeting on the 6th of June. I suppose there's a huge anticipation as to will they reduce interest rates. I think the answer possibly will be yes at this point in time. But I suppose when lenders are pricing their interest rates for me and you, for lending, they're basing it not off the European Central Bank interest rates. They're taking it off the Eurobar. So the Eurobar is the interbank rates, I suppose, the price they're paying for money. And I suppose they're hedging to see what does that look like into the future. And it looks positive. So the asking price today for funds for banks is around 3.8%. But if you look out into the next 5 to 10 years, you're seeing that at 2.5% to 3%. So the future is bright, I suppose, for interest rates for consumers. And hence why we're seeing banks now building in a rate reduction into their rates. The thing is, and I suppose, David we might support this as well, we have 70,000 customers that are about to roll off fixed interest rates. And the question now is, what do I do?
So what, and in fact, let me bring David in. David, an awful lot of people, up to 70,000 people rolling off fixed rates. What should they do?
I think, as Margaret said, the landscape is changing. It has dramatically changed from where it was till now, and many tracker rate mortgage customers have been under immense pressure with the cost of living crisis and the inflation that Margaret mentioned throughout Europe, and then coupled with significant 10 successive rate rises to have a very different landscape for many people. Some, believe it or not, don't have much sympathy for tracker rate mortgage customers, including the Department of Finance, I believe, and they've been under severe pressure. I'm hopeful that June will bring the beginning of some rate reductions. The market has already built those rate reductions in. Some of the banks now, fair to say, aren't exactly the most charitable organisations in the world. They have indeed had the benefit of deposits and been able to utilise the deposits and make some money. And I think you're going to find some of the lenders will have made record profits last year. Despite these interest rate rises being passed on, they are being passed on with a preference to the lenders. But the positive part for the main three lenders we have, they have not passed on the full interest rate. And that's been very, very welcome. And very, very fortunate for many people who still are having higher variable rates. Less so fortunate for the tracker rate customers, and even less fortunate for those then who are in mortgage difficulty, and some who are not in mortgage difficulty, who are sold to vulture funds, who seem to be borrowing from casinos, and therefore the rates that they are applying are very, very significant. But the question you've asked, Adrian, and the question Margaret raised is a very serious question of people who are coming off fixed rate mortgages, and those who are on interest only rates as well are the biggest single challenge now, and they have all increased in age and the properties have decreased in condition, and therefore there is significant challenges ahead. And the advice to anybody is there's a cohort of professional mortgage brokers in the state. We only have three main lenders and Avant, and now we have a Spanish bank looking to come in, which I sincerely hope they really come in. The Central Bank, in my view, and I've said this directly to the Central Bank, have scared away many people from over-regulation in the state. And we've lost many, many lenders. And also the elephant in the room is the lack of family home repossessions. But I think people need to engage with professional advisors to have a look around. There are preferable good rates there, as Margaret mentioned. People need to look, need to do their homework. It is not a time to sit in your hands. It is not a time to sit in your rear end, because the difference in the money each year is in the thousands. And it's very, very important to secure the best rate.
Now, we were talking about increased competition. We know a number of lenders withdrew from the Irish market, but it's good to see some lenders starting to come back into the Irish market. And Avant Money have shaken things up a little bit, but their parent company, which is Bank Inter, are planning to enter the market as well.
Which is very positive. So I suppose Avant Money is financed through Bank Inter. That's where they get their funding. And it's great to hear that they're coming in and putting a retail presence into the Irish market. And they will shake it up. And David has referenced this with the interest rates that are being paid on deposits. Bank Inter will probably come in with a very, very decent rate on deposit accounts, and that's their I suppose their starting market. But Avant, I suppose, when they first came in, they did price disrupt. They came in with that 1.95 back in the day, and it absolutely disrupted the pricing market. And they're doing something very similar again. They have a very good interest rate, which is a 4-year fixed interest rate, which is 3.6%, and that's on all properties, not that green B3 elusive property that we see, I suppose, the market leading rates. But going back to that point, with those 70,000 people that are rolling off their fixed interest rate, David alluded to that there is a significant amount of money to be saved. And if you take an average mortgage that is 300,000 over a 20-year term left in it, you can be guaranteed that there's a low loan to value there as well. And if you put that onto 3.6%, they may be rolling from that 2.8% onto potentially a 4.1%. The annual savings on that going from 4.15 to 3.6% is for over €4,000. That's literally out of a client's pocket. You add the interest saved, and sometimes the customer forgets how much interest they pay over that term. That interest will save from 3.6 to 4 or 4.15 to 3.6. The interest difference there is 6,300. So that's over 10,500 over 4 years. I actually spent an hour last weekend checking my car insurance for €50. You know what I mean? Most lenders are now paying either 1% cashback or €2,000 or €3,000 or €5,000 is available also on the market for switching your mortgage in. So it's worth the pain, and all mortgage brokers will give you free advice.
And is it painful?
Well, it is a mortgage application. It's a reduced documentation mortgage application, but it is a mortgage application. But what I'd say, Adrian, to every customer, put aside 2 to 3 hours. You know what I mean? Put aside, download your bank statements, download what the paperwork is required, and you're saving €10,000 over 4 years. It's a significant amount of money.
It's a no-brainer by the sounds of it.
It really is. Yeah, well, the conversation is a no-brainer. And there's certain customers that we turn around and say, do you know what? It's not worth your time switching. You know what I mean? If your mortgage is small, the term is, small, sometimes it's not worth it. But for larger balances, it is absolutely significant amount of cost saving.
Now, David, just to go back to you for a moment, the talk now is of an interest rate drop in June. It's certainly Christine Lagarde has certainly hinted in that direction. Are we likely to see it, and how significant will the interest rate drop be?
I think the markets are saying a 0.25 or at best a 0.5 reduction. Some will say it's 0.25 in June, and with one more rate reduction of 0.25 maybe October. So it depends who you ask, Adrian. The tea leaves are required on this one, but I think it's about to go the right direction, which is very, very important. And I think that'll give many people have had to shore up the difference in the rates over the last number of years out of their own cash. And this has had an impact where people were having to pay that extra couple of grand a year out of savings, the money they already had. And those who don't own homes, obviously, didn't have a huge amount of sympathy for those who did own homes. But ultimately, it was a painful experience. There is money to be saved on that. And I think this will be the first downward. I think there'll be caution. I think the ECB seem to be cautious, as Lagarde going to be cautious not to have to go downwards at rates, only to go back up again. I think we need to see the whole European situation stabilise and the Irish situation stabilise. But I think it's going to start going down, and it depends on your market. Depends which market analyst Margaret reads or I read, different people. But the only certainty is a downward, I think modest, and hoping for 0.5 by the end of the year.
Now, something else that you alluded to a moment ago, David, is the fact that we have an issue in this state with repossessions. 120,000 people currently in arrears. What do you want to see being done here?
But I have a sort of a controversial view on this, which is, there needs to be all our organs of the state need to work in concert to ensure that those who shouldn't lose their homes have every opportunity to avoid losing their homes. Unfortunately, there's an elephant in the room, Adrian, and there should be repossessions, and ultimately a marketplace doesn't function with repossessions. And my view, which is slightly controversial, I've told the Governor of the Central Bank, the Department of Finance, and all of the creditors are well aware of my view, which is for those. There will be people who will lose their homes. That's going to happen because some are messers. Some financially still cannot afford the property that they're in, and no restructure in the world or any divine intervention is going to allow that to happen. However, the lack of repossessions and the dishonesty in relation to the fact that there should be all of those people in mortgage arrears should be before the courts. And that might sound a counterintuitive thing for me to say, but my theory for saying that is that had that have happened, many people who could have been helped would have been helped, because it would have forced action. Behaviour, unfortunately, dictates that if you're sitting in a house and you're squatting, many now have come to the view whereby they're ducking and diving. The stress and the aggravation that's causing them and the health harm that has caused over the last 10 years, they're now 10 years older. They're 10 years less in employment. The property is now becoming into a worse condition and they can't afford to fix it. And over the winter, there were many people in mortgage arrears where boilers and stuff could not have been fixed. So there needs to be a proper intervention. There needs to be an amnesty till the end of the year, and then everybody needs to be dealt with on a case-by-case basis, whereby those who are meaningfully engaging, but also the lenders have a part to play here. The historical mortgage arrears solutions, of which there's 95,000 of them out there at the moment, Central Bank has given concern, as we have over the last number of years, that some of those are unsustainable. And indeed, those solutions, though, and similar solutions are not being offered anymore by the lenders. And 80% of the long-term mortgage arrears now have transferred across to vulture funds, who are structured differently. And the big elephant in the room with the vulture funds, apart from the normal, the big bad bastards, leaving all that aside, they have securitization vehicles. They have parceled these loans into different pockets of financial instruments that now further impede and restrict any resolutions or solutions being given to mortgage holders. So there needs to be repossessions. There needs to be no unnecessary repossessions. And we need to have an environment in such a way that the central bank, in a meaningful way, oversees the regulated entities to ensure that proper, affordable and coherent, it's not credible to have sold a loan for 50% of a discount to a vulture fund when that bank could have restructured someone's loan, Adrian. That's just not credible anymore.
All right, and let's finally, Margaret, look at the market today. We see anecdotally a lot of housing being built. We see the banks issuing a lot of mortgages, but you have some advice for that step, for the step where you're applying for a mortgage.
I do. I've loads of advice I can give, but I suppose what we're hearing in the broker market at the moment is that we're speaking to customers and they're coming on, they're saying, oh my God, I'm in my late 30s or my mid 30s. Is it too late to buy a house? What I want to say is that the median age of a first time buyer in today's world is 35. It's significantly higher than what it was. If we go back to 2004, that age bracket was about 14% of the mortgages. So it's, we're definitely an aging population. And that's probably down to we don't have housing, that we have, all those old things that have been, talked about at length with housing supply. Banks are open, Adrian, and banks are lending. That's the number one thing. And whilst we have a reduced competition in the market, they're still very competitive when we look at our counterparts in Europe. Drawdowns for the first quarter reduced, right, okay, which is interesting, but I think that's probably again down to property supply. So we housed 8,419 people in quarter one. The interesting figures is that we actually approved 3,779, which is an increase on 5.5%, right? Year on year, that's down 16%. Again, that's indicating, I think, a problem that we need to look at. But 64% of our market is first-time buyers, and we're herding that cohort of client into new builds because they need the Help to Buy scheme, they need the First Home scheme, and those schemes, which are very, very useful and we do need them, are only applicable to new houses. So unfortunately, we're creating another problem because we're not probably building enough houses in the 30 or 40,000 that will come to market this year. We're stopping the second-hand properties coming to market as well because interest rates obviously have been high for the last number of years. So we have a problem, but I suppose the good news is that if you are living at home or if you're renting, it's definitely cheaper to buy a house for a mortgage repayment than paying rent in Dublin or Cork or the many large cities across Ireland. take the conversation with a broker, get your paperwork in order, see can you afford it. There is, as I say, those incentives will actually help you to buy your property.
Brilliant. Margaret Barret, Managing Director with Mortgage Navigators. Thank you very much indeed for popping in, Margaret. And also our thanks to David Hall, who is the CEO of the Irish Mortgage Holders